Okay, hello everyone. Welcome to this week's study session. Going to record the general market section, and then I'm going to do a separate video for stocks. Just doing this on a Saturday afternoon. I still have some stock work to do. So let's take a look here at the risk model. A couple interesting things to talk about today. Um, of course, looking at the risk model, we went on a sell alert as of May 6th. Buy signal is still in force from April 6th, but we moved over to a sell alert as of May 6th. General market neutral. If we get a little bit more positive action in the market, that would get lifted. See what the general market looks like this week. Up down volume still positive. That's right on the verge of maybe going negative too. So we could see a sell signal. We could see us going off of sell alert. It really depends on which way we turn in the next few days. New highs, new lows, positive. Stock participation, we still have as negative, and we're going to talk about that today. It depends on, I guess, where you're looking, but the broader market is where I'm looking, and it's definitely negative as far as stocks moving out from breakout levels. Again, we're going to talk about that in depth here today in just a second. Looking at the long-term trend model, still solidly bullish from that buy signal April 6th back in 2020, up 47.25%, the S&P 500 since the buy signal. So 401k money, you would stick with that long for now. Today I'm going to talk about participation, winners, losers, and tactics and feedback. I want to go over just contrasting some of the areas that have maybe worked, some things that haven't worked, and sort of the whys behind that and what we're faced with looking at applying the tactics, at least that I use, and some of the feedback that we're getting. So the Dow, as usual, this is really in making people get frustrated. We've had a very, very small number of members that have sent us, maybe, five or six of you have sent us some emails saying, hey, how come we're not in the Dow stocks? How come we're not trading the cyclical stocks? Well, the answer is because number one, I don't have a crystal ball. Number two, we're sticking to our strategy, and our strategy right now, and I'm going to show you exactly why in just a second, but not to be facetious, but 30 stocks leading the market or even 500 stocks with the S&P 500 isn't market leadership. All right, that's a narrow market. Just like Kathy Wood, someone who's down 34% right now off her highs, is talking about a broadening market. It's insanity to say those words right now with what's going on. I'm going to show you the market is narrowing. It's doing anything but broadening. So as we get narrower and narrower here, that is the last time that I'm going to ever be doing well in the market, is when we're getting so narrow where 30 stocks are leading the market. Meanwhile, you take a look here. This is looking at the NASDAQ. So if we just look at the NASDAQ index alone, that doesn't look like an index that's breaking out and making big moves in any way, shape, or form. It's been moving sideways in a big giant base since mid-February. It's gotten nowhere. Right? Actually, you're lower than you were in February, right? So it just looks like a big base being formed, and we were trying to tighten up. If you remember, I talked about this right side. Remember, I said over here that it looked like if this was a stock, it was perfect. This was a week or two ago. But I said indexes don't act like stocks. They're random, they shake out. So a stock, yes, I'm buying here, breaking out of this nice tight pattern, VCP tightening up. But look what happened. We got the shakeout, just like I suspected, because that's indexes aren't stocks. Now, let's take a look at what's going on with the stocks beneath the surface of the indexes. If this is a broadening market, I'd like to know how we go from 80, I don't know, 85, 88% of stocks above their 50-day to 39% of stocks above their 50-day moving average. Meanwhile, the Nasdaq is still above its 50-day, and we're below the 50% mark. So more than 60% of the market is below their 50-day moving average. So on an intermediate term basis, that says that you're correcting, right? And you can see, of course, this incredible divergence. All right, let's look at the 200-day. Percentage of stocks above the 200-day moving average. We're back here in February. We're up above 80%, 85%. Now we're at 57%. Again, how's that a broadening market? When you've got 40% of the market has turned down below its 200-day, which generally the 200-day is a pretty good distance below where you would be trading. previous, looking at the NASDAQ here, we're a good distance above that 200-day, which is another problem because we've got a divergence here where less and less stocks above the 200-day while we're extended from the 200-day. So again, this can correct itself. This doesn't mean that we have to go into a big correction or we have a problem from this. It just simply tells you what's going on with the individual stocks. And this is not the type of picture that says that we're getting breakouts and we're getting stocks setting up and we're getting a broadening. I don't know how anybody would use the term broadening under these conditions. So you couldn't have a more drastic, going back to, let's go back to Cathie Wood here for a minute. I know sometimes I beat up on Cathie Wood, but personally, I think that her method and her funds are the most overrated since a woman named Abby Joseph Cohen. I don't know if anybody remembers Abby Joseph Cohen. She just stayed bullish for like 20 years and then went through corrections of, giant corrections in bear markets and, was hailed as this, this amazing analyst when, she'd go through drawdowns of 50, 60%. To me, I just can't claim that somebody's great if they go through a 50% drawdown. It's just that to me just isn't a great manager or analyst. So right now, looking at this, comparing the Dow Jones to ARC Innovation, I mean, look at this drastic and this is supposedly one of the best in the business, right? Below the 200-day, right? In a downtrend off, I think I have another chart here. Yeah, off 30, almost 34% off the highs. That's bear. Those are bear market numbers. Those are bear market numbers. This is a fund. This is a fund. This is a diversified fund. This isn't one stock off 34%. So let's take a look at some individual names recently that came out from breakout levels. Incidentally, many of these, or at least a couple of these, or some other ones that I could talk about, are some of Cathie Wood's newest buys. Cathie Wood, not Woods. Cathie Wood bought TXG. I bought TXG also, but I stopped out of it, right? She's buying this thing right before earnings. And I would think her research would tell her that there's going to be a blow up. This thing blows up in 8 days. Now that's why I didn't hold through earnings. In 8 days, down 25%. Nari, remember, Nari was setting up perfect. I loved it. Setting up perfect. If it tightened up, that's a stock I'd be all over. 3 days, down 20%. Twitter, down 28%. Cathie Wood buying it right before earnings. Gets blown up on earnings, 28% in 16 days. Again, these are bear market correction numbers. Uber, 24% in 16 days. KLIC with the SOX, everything was trying to set up. Wham, comes in 23% in 9 days. Snap, 20% in 6 days. All these names, even steel, just because, okay, we've got some steel stocks. I know some of you have said, hey, the steels are setting up. Well, we tried STKL, that got stopped out, and now down 27% in 18 days. Of course, Zeus broke out, and that did really well. But even that ran into selling, which I'll talk about in just a second. All right, we'll look at the small caps. Small caps, basing. At best, you're moving sideways. Just in a base, all the way back to February, you've gone nowhere. All right, take a look at FFTY. However we slice this market, the only way it looks good is if you happen to have a crystal ball and knew that the Dow 30 was all of a sudden going to lead for a little while, which again is absurd to think that we can that's all in hindsight. Yeah, it's easy to say now, but again, all the broader indexes and the indexes that would more represent the growth type names, the names that I would generally traffic in, have all been moving sideways to correcting. Now, a few names. Yes, we have tried some cyclical names. We have Zeus worked out great just the other day when it popped and you got a few days, but even that ran to 3 days, 3 days up, and whammo, it gets creamed. I can bring that up. Let's just take a look here. ZEUS. I think it came back, ripping back a little bit, but look at this volatility. Again, comes out 1, 2, 3 days up. Nice move. Still, the selling the pops is still the way to roll here, is to sell into the strength. Now look at this volatility all the way back down. Now, again, if this rights itself and it goes even higher, you could say, oh, well, see, you can look in hindsight. But could you sit through these pullbacks? Could you sit through where you're up 25% and the next thing you know, you're at a loss? I can't. I'm selling. I'm breaking even on that trade at best. PDCE. All right, that was just, of course, on Friday. So some of these are coming out on earnings. That's another problem. Is we got we're in earnings season, and some of them you're getting where they're not gapping. You're actually getting them coming out of a base. PDC, another one. This is an energy name coming out of. This is a nice, well-formed base, nice right side. So buyable. We talked about that one. HGV we're in, right? FedEx. I even tried Boeing. Boeing didn't work. DKL, GM. We got a couple of trades on GM that worked. Ryder got whipped around. It's doing better now. Again, a lot of random action in some of these names that you look in hindsight and you see they're higher. But again, there's a section in my book that I talk about the bucking Broncos and getting from one side of the corral to the other. Okay, the horse gets to that from that one side to the other, but can you stay on the horse? Or do you get bucked off midstream? That's the key, is that we have to be able to stay on these trades, get in them at a low risk entry point, not get stopped out repeatedly where the losses pile up, which has been happening. You have to take a look at how you got there. How did that stock get, even Bitcoin? You see people say, well, if you bought it at, whatever, 20,000, it's at 64,000. Yeah, but you had to go through an 85% decline first. All right. Can you go through that? I just had a friend of mine the other day call me and he said he wants to put $1 million into Bitcoin. Wanted my advice. I said, if you're willing to lose $500,000 in the meantime, I mean, I don't know if Bitcoin is going to go down 50% first or go up 500% first. I have no idea. I don't think anybody knows the answer to that. So what's happening here, and here's a handful of names, and some of them that, we've been in. Abbott, we've been in. We're looking at names that are gapping from bases. You have to hold overnight into earnings, so you have earnings risk. They're extended from bases, and then they're gapping from already being extended, or they have these compressed right sides where they're running right up the right side. I've been doing this for 37 years. If you are playing a pair of eights or king 10, and I'm playing aces and kings, and you're beating me, that's fine. It's not going to be for very long, though. Okay. Just because you lose with a good hand doesn't mean you made a bad play. And just because you won with a bad hand doesn't mean you made a good play. It means you got lucky, because over time, my aces are going to beat your pair of eights. Guaranteed. This is a game of probabilities. And I'm going to tell you, if you chase these gaps, hold into earnings, buy extended names and compressed right size, like we're seeing in a lot of these names, that would require for you to be in some of these names that are running up on gaps, and many in the cyclical area. Yeah, maybe you're in the right place at the right time and you do well, but you'll be a loser over time. You'll give it all back. It'll all go away. Just trust me. Taking a look at a few of these names, let's just look at LQDT. This is one that we had a member, and I shared this, send in an email and talk about how they traded this. LQDT, let's bring that up. So here's a play that you can make on earnings. You can buy earnings. You can definitely play earnings and even an earnings gap. If you're gapping on earnings, that's fine, as long as the gap isn't gapping away too far from the pivot point. If you're still within that 1%, and this is exactly what this member did, a nice play. I want beautiful play here, tightening up right here, still coming from a pivot. And this is exactly what I'm saying, where you're not changing anything. I really got to address this. Again, it's a very few people. We've got just a handful, but I treat even if 5 out of 500 people comment on something, I'm going to address that. I want everybody to do well. I want everybody to be on the same page. I'm here to teach everybody, not just the people who agree with me or the people who can see the light. So we're getting some of these emails talking about changing strategy, that I've changed my strategy. I haven't changed anything. Okay, I'm buying from the same breakouts. The only difference is that instead of holding for a bigger move and waiting to get stopped out 50 times in a row, like all these stocks are doing, I decided, you know what? I'd rather not lose money. All these stocks are going up 1 to 3 days. I think I'll take my profit and make a nice big fat return compounding it. Isn't that better? I would think that's better. But some people don't. They would rather, instead of making a fortune short-term trading for a little while until things settle down here and we get better swing trades, I guess they'd rather have me give you swing trades, or I am giving you swing trades. They're just not working, but would rather have me personally do swing trades and lose money. So I just don't really understand these comments. I just don't understand it. We're not changing anything about the strategy. I've been doing this my entire career, and I've been short-term trading around positions and short-term trading into strength when the other options aren't available. Now, guess what? This short-term strength option is not going to be available always. It's not like this is something that we can even do all the time. So we've got to be flexible in our observations and flexible with our tactics, but never flexible with our philosophy or our strategy. There's no flexibility whatsoever in my philosophy. Just like this, and I'm circling back here because this here is a perfect example of this member bought this gap that didn't gap too much. As it went up, when it got up enough, I think it was 5%, he said, to cover his stop. His stop was at 5%. He sold a part of it, I think half of it, and then started scaling out as it went up, ended up making 20% on the trade. I don't know how much did this thing even go up for the day. Yeah, so it was up 37 or so percent on the day. Wow, big move. He made 20% of that simply by and in a very low risk fashion, right? Bought the gap, started with a 5% stop. As soon as it got up that 5%, covered his risk. Now he's free rolling on an earnings gap. If it blows up, if it takes off, great. It did. Scales out and nails down 20% in 2 hours work. That's the way you do it. That's the way you do it. And he could have played this for a bigger move. If you want, hold a piece of it. It's so strong. Maybe sell the half, you free roll, and now you hold it for that swing trade. Okay. These are tactics. All right. And I also, we've had some other a few comments, one in particular that I commented on before, where someone said, this sounds like a lot of work. Yeah, it is a lot of work. I mean, did you think that you're going to have super performance trades and make returns like you read about me in Market Wizards by having a part-time effort and doing very little work? I mean, I don't understand how anybody could ever think that. So my advice to anybody who doesn't want to do a lot of work is give your money to a good hedge fund manager. Put it in the S&P 500 when it's down, when you have a bear market, and then you'll make your 9, 12, 15% a year, and you won't have to do any work. But if you want to go that extra mile and you want to be great at something, you want to nail down those big returns, and you don't want to go through those big drawdowns, it's going to take work. It's going to take a change in tactics and take adjusting. It's going to take lots and lots of boring, frustrating, fruitless endeavors that you feel like you're getting nowhere. That's part of the business. I'm sorry, but that's part of the business. Let's see here. Let's go back. So you can look at these names here. Take a look at some of these names and how these are all big movers recently. But many of these, you had gaps, and you have to take that gap risk, or they're extended, or they're running up the right side, like an OCDX. Real quick, OCDX. So OCDX, look, gap off the lows, straight up the right side. You had earnings on this day that into new high ground. That's not playable for me. Okay, are you gonna go back and look at that and say, here's a stock we should be in? No, we should never be in a stock like this. I don't care if this goes up 10,000% from here. I know that this play is going to cost me money over time. It's going to cost me money. This is playing up a pair of twos or whatever we want to call it. This is not an ace, king, queen hand. All right. Strictly from the risk management standpoint, it doesn't matter what the reward is, that risk side. If this recent period of having, I don't know how many, 45 out of 55 breakouts stop out on our swing list, I mean, if that doesn't tell you the risk in the market and that it all has to come from a risk standpoint, everything has to be looked at from risk, I don't know what makes the point. So again, the best advice I think I've ever given in 11 years that we've been doing this is, and the best move that I've ever made is changing over, almost exclusively to selling into strength and staying away from the larger swing moves and allowing the stocks to have that room. Like I always say, if there's volatility, and this is consistent with everything in my books, you go read my books, I'm practicing what I preach. What I say on volatility is you have to cut volatility off. When you're having trouble in your account, read this section in my book where I talk about what to do when you're having trouble, when you're getting slippage, when you're running into a losing streak. It's not to widen your stop. It's not to change your strategy. It's to cut the volatility off. It's to chop the volatility off, tighter stops, tighter entries, smaller gains. Everything that I explain in my book, I just employed perfectly. And then I have a handful of people saying that I'm changing my strategy. But they didn't read my book very well. Okay. So go back and take a look at the section that talks about adjusting for volatility, adjusting for slippage, adjusting when you're having a difficult period. I'll be more than happy to share that page in just a second if you guys need it. Let's see here. Okay, let's see. Let's move on. So, in summary, most stocks are basing at best. Yes, we have the Dow that's breaking out here, and there are some stocks. I mean, there's a good number of stocks that are moving up here. It's a completely bifurcated market. You've got, I mean, I've never seen a market so split where it almost looks like if you were to look at, anything from the Dow to the Nasdaq to the Russell to the ARK funds to some specific ETFs, they look like completely separate markets. You could say one is like the Indian market and the one is the China market and one is the US market. And they look like completely separate markets. They've decoupled so much. So what I think that we might have here, which I'm hoping we're having a stealthy like correction, where a stealth correction is where you correct beneath the surface and stocks sort of rotate through and correct through different groups, and it's a rotational correction that takes place, and the indexes sort of mask it. You'll see the index are basically basing or even trending a little higher, but you've got a lot of stocks that are breaking down and you're rotating. The key is that where are you rotating into? Are you rotating into new leadership, or are you just running up old leadership? And maybe stocks are getting more extended, and you're narrowing even more. And that's what we have to watch here and see if this narrowing into the Dow kind of names, if this is something that's a later stage, or if we're actually resetting here and we're getting new leadership. Very, very rotational. And this market is so rotational. You go from one day to the next. It could be anything from cyclicals to growth to growth cyclicals, just amazingly rotational. Gaps on earnings, gaps from extended bases, very narrow leadership, and volatility around the pivot points. That is the real killer. The volatility around the pivot points. When I just showed you those names that you're down 28%, in 3 days, 5 days, 9 days, those are coming from, those aren't just stocks that are down. Those are stocks that are down those amounts from breakout levels, from pivot points, from setups. That's a very, very dangerous market. See, if there's nothing setting up, you can have stocks down at 50%. It doesn't matter because you're not going to be in them. You're not going to get sucked in. But when a stock sets up perfectly, or what you think is perfectly, there's always something wrong. Maybe it's in the market, whatever it is. It's either the market or the stocks. But if you're doing your research right, technicals are right, you're buying them, low risk entry points, you're doing all that you can. And those aren't working. That's where you get yourself into a lot of trouble, because now you don't know. You see that the stock's setting up, so you have your faith in those setups, but you have to have also, you've got to respect the feedback. This is why we have to make sure things are working. That's why I use progressive exposure, and you're only trading aggressive and larger when things are working. See, the market trends, you get themes. We've seen the theme. I pointed this out a long time ago, months ago. I said the theme is institutions are selling into retail buying. Do you remember that? How long ago did I start saying that? Months ago. It's still happening today. That's why you get a Zeus that runs up and then comes all the way back and gives up 25% of its gain in a matter of days. That's why you get that whole list of stocks I just showed you that break out, and they're down 25% in a couple days, 3, 4, 5 days. That, again, as O'Neill and I, we use different aunts. His is Betty, mine's Sue. Someone's aunt that's not them selling, right? That's not Aunt Betty selling. Those are institutions that knock a stock down, 25% in a couple of days. So that's institutional selling. That theme, I nailed that theme dead on. I played it perfectly, and that's why I've got a huge return in the U.S. Investing Championship. And I gave you a heads up on that early on. All right, and a lot of you have done that and have done great. Have gone great, and I'm happy about that. But there are a small handful that I think stayed very stubborn, and now maybe you're bitter. So I need to address, that, and that's who we need to get to improve here. The key is to make sure you go back, take a look at what happened, what you did. Don't Monday morning quarterback and say, "Oh, I should have been in these stocks that didn't meet my criteria." Well, it was in the same comment actually. Someone who made the previous comment I said that there was setups. Why are we ignoring these names just because they're not the groups that historically has shown us the biggest winners? Uh, yeah, that's part of it. Yeah, yeah. I mean, when you go back and you look at every cycle going back for 100 years, and almost never are those particular groups ever in the fast, big moving areas. Yeah, yeah, I do respect that, and I do discount that because, like I said, we're playing probabilities. I'm not trying to all of a sudden say, well, it's going to be different this time and try to pick a needle out of a haystack. We're going with what works over time, and the science with the scientific evidence, and my 37 years of anecdotal evidence tells me that works over time. And again, I made the shift. I made the shift. I told you exactly what was taking place and how to get through this difficult period. You still got the breakouts. We still got all those breakouts. All you got to do is just sell them into strength, and you have a big return right now. So again, I'm not going to keep beating this horse, but you see, I'm very passionate about this today because again, one client tells me they're not doing well, and I'm upset about it. I want to save everybody. That's how I feel about my clients and my members. Everybody's important. And some people, even on Twitter, they'll say, "Oh, why do you bother with these people who will, make bad comments to you?" Because they're the ones who need it. People who are doing well, and I certainly don't need to teach somebody if they're using my techniques and doing them perfectly. It's the people that aren't executing it properly, the people that are having difficulty. Those are the ones that need the help. So I think that, that's where, Mother Teresa doesn't go, she goes in the streets with the poor. She just didn't go to help the wealthy people, right? So anyway, please, I'm not comparing myself to Mother Teresa. Let's not get emails on that now. But anyway, all right, you know the point I'm trying to make here. So let me run so I can actually do some stock work and see what the heck we got going on here with these stocks, and if there's anything that's in viable position, and then I'll do another video. All right. Thanks. Bye-bye.